I would say the biggest difference between Canada and the US is Canada, in terms of its investment scale, is a smaller investable universe. The players are highly institutionalized, well-capitalized, and there's generally just less leverage in the system. So by virtue of that, there's just less forced repricing. And because these institutional investors are well-capitalized, they're able to withstand some of these cycles. So they're able to hold on to their assets a little bit longer. So the repricing in Canada has just been more of like a slower grind rather than a sharp increase.
Welcome to Colliers Talks, a podcast series featuring the latest trends, insights, research, and developments in commercial real estate in Canada and beyond.
Welcome to Colliers Talks Economics, where we discuss what's happening in the market and try to give some insight and valuable information for investors, landlords, brokers, anybody involved in the commercial real estate industry. I am your host, Adam Jacobs. I'm the National Head of Research at Colliers. And we've had many guests. We've had landlords and economists, but I don't know that we've ever had an appraiser guest before. So welcome, Amedeo. He's the head of valuation at BentallGreenOak, a good friend of mine, and we've been on panels. We've discussed these topics before, but that's always just a broad brush, high level. So now we have some more time to dig into this and ask some real questions about valuation, the current market, and where this is all going. Amedeo, let's start with your favorite topic, one we discussed at the Real Capital Conference last month, but the disconnect between the appraisal value and the real market value of property. And maybe there's always a bit of a gap, but it maybe feels like that gap is larger than it normally is, or it's expanding instead of contracting. So we've heard a lot. I know you've commented on there's a disconnect between sort of the reported valuations, the reported returns, maybe at an index level or at a landlord level versus like what's actually happening in the market, what we see in rent growth. And maybe this is a little more acute in Canada where we have a few less transactions, the cycle's a little slower than maybe what we see in England or the US or some other market. So from your perspective, is there a gap? And if so, like why here versus some other market?
You know, what we're seeing in the index results is more of a gradual incremental repricing rather than a sharp change. So from that perspective, it just seems as if there's maybe more stability in capital values versus what we're seeing through the market statistics, the investment transactions, and what's playing through our own appraisal programs.
Yeah, and let's dig into that a little bit more in terms of when you say the leasing fundamentals, they're improving, they're degrading. It depends on the asset class because we have a good news story developing in the office sector, I think, where people have wanted to wait out the cycle, wanted to see the upswing happen without taking that huge write down. And perhaps we have weathered the worst of that. Perhaps there is upswing, or do you think we're still way out of whack with what the sort of reality of operating income and leasing is versus valuation?
Yeah, I would say that in real time, that's certainly happening. But when we look back at appraisal results and what I'm seeing through my own program, generally what we're communicating is rents are continuing to decelerate. So downward pressure on rents, and that's coming through, the leasing benchmarks, the stats that we're seeing through the broker reports, and the feedback that we're getting in real time through our leasing teams. But in the appraisal, what we're seeing is that this rent deceleration isn't really playing out as quickly as the stats are supporting and the evidence is supporting. So with cap rates and investment parameters being relatively stable, we're seeing less of a translation in values. We'd expect more downward pressure on value, and that's just not happening. So if you look at some of the core industrial markets like Montreal, Toronto, and Vancouver, those three markets experience explosive rent growth. That has tapered off. We're not seeing that translate, from my perspective, fast enough in the index results. Now, are rents still healthy? Absolutely. I'm not saying it's a full fall off the cliff. When we're seeing our leasing transactions play out, it's still higher than those at expiry. But from peak, I don't think that that's moved enough. Same thing in office. We've seen very strong leasing momentum in the trophy sector, but it's a different story in those kind of lower caliber or lower tier office assets, say the A and B sector. For me, there's more rent discovery, and that's largely predicated on the elevated levels of vacancy in that sector. And then it's going to be building specific, and that's going to be largely tied to how much existing vacancy you have and what leasing concessions or inducements you're going to have to offer tenants. And that's going to be a building by building. That's going to be building specific, and we just haven't fully seen that play out because leasing activity has only kind of come about in the last kind of 3 or 4 quarters, and there still is, in terms of the appraisals, a lot of discovery coming in for net effective rents.
Okay. And I know you've said before that appraisal is a lagging indicator in a lot of ways. Like as the market accelerates, we'll see it later this year or next year, perhaps in the like more transaction volume, more leasing leads to more price
I would say
discovery.
in terms of the appraisals, it's going to be like how well has your appraisal program kept up with the leasing activity. If you haven't, you probably have more negative pressure on your net effective rents than, say, another program that's, been keeping up with the leasing momentum or the leasing activity as it comes to fruition.
Okay. So let's zoom out a little more, even big picture, our market versus other markets. We all know the US is a very deep, liquid, decentralized kind of market, and you see prices snap in both directions pretty rapidly. The highs are high and the lows are low, and when they go into a downswing, it's a really big one. But there's also a silver lining to that in terms of repricing and the ability to start the cycle over more quickly. I think when we went to a RealPAC event recently, they said it's now just 4 years in Canada of kind of the values drop 4 or 5%, and then they drop another 4 or 5%, and they drop another. Like, it's just, there hasn't been the collapse in valuation, but it's also taking a long time. Like, a slow repricing is kind of stalling the market out. So what is it about our market versus the US market? It's the size, it's the lenders, it's the landlord profile. Like, what is it that's making things so different?
It's all of those things. I would say the biggest difference between Canada and the US is Canada, in terms of its investment scale, is a smaller investable universe. The players are highly institutionalized, well-capitalized, and there's generally just less leverage in the system. So by virtue of that, there's just less forced repricing. And because, these institutional investors are well-capitalized, they're able to withstand some of these, cycles. So they're able to hold on to their assets a little bit longer. So the repricing in Canada has just been more of like a slower grind rather than a sharp increase. And I think that's the biggest contrast between Canada and the US.
Agreed. And I think there are some differences this time. I'll editorialize a little. And I was just reading about this, like the lending and credit environment changes over time. And I think one of the things we all underestimated this go round is that like private debt and private credit is a very big player. People want to look back at 2009 or something like that and say that's what's going to happen. There's a downswing and then the resultant upswing. But I think things are a little more insulated in a way now with private credit. Private lending is much more built up, and it's floating the system a little bit, right? Like, it's sort of preventing some of that really big. You see these stats from the past, 20% of investment sales were distressed or something. We're now nowhere close to that, even in a down market. And I'm not sure that can happen anymore, just because like the lending environment matures and gets a little bigger and a little deeper. Would you say that's fair?
That's fair. Yeah, for sure. I think it's just less, like I said, less leverage, less pressure.
Yeah. Now, okay, cycles are happening all the time, but not every cycle is the same. Like, do you feel this is just a typical, like the cycle we went through was kind of unusual in that it was kicked off by COVID, lockdown, school closures, 0% interest rates, all of these crazy sort of unprecedented things. But we had the virtuous cycle, the cap rates go down with debt, and then the cost of debt goes back up and we find ourselves a little stuck. So like, what are you seeing here? You mentioned that like there's like the income side and the cap rate side, and they can each like kind of put pressure on the appraiser or the lender or the owner. Like, what are you seeing there? Can you?
When most people speak to valuations, it's generally a cap rate discussion. And what I try to remind people about is there's two things that impact value. There's the income and then there's the capitalization rate. So as you said, I think we're, in terms of, where we're currently now, it's stability in investment parameters from an appraisal perspective. We haven't seen a lot of movement, and that's probably largely predicated because deal flow has and continues to remain a bit thin, even though we have seen more transaction come out in the back half of 2025. But it seems to be more now of a cash flow repricing or rent repricing rather than a cap rate change. So what we're seeing is just a change in or recalibration in achievable rents. And that's the big story in all the sectors, multi-res, industrial, office, and even retail.
Okay, now let's get into it a little bit. Those leasing markets or those fundamentals, operating income, rents, like, pick an asset class and tell me what you're seeing. Like, there's been a lot of focus on office. Q4 office leasing was, amazing. It was at the levels we hadn't seen for 8-10 years. The skeptics say, well, that's just kind of the one-off catch-up for return to office. The optimists say, no, new paradigm. We're back to downtown being healthy. Like, or if you want to talk about dropping residential rents or development in that sector, like pick an asset class and tell us like what you think the leasing and the fundamentals look like there.
Yeah, I think there's some consistency across the board, and it's generally a bifurcation story between top tier A assets versus B assets. And that's playing through in almost each sector. So for office, like I said, we're in rent discovery to the up and to the down. So in trophy assets, we've seen very, very strong leasing momentum. We've seen rents holding, concessions coming down, whereas in kind of older or in other sectors or older, A and B class buildings, we're still, like I mentioned before, in a net effective rent discovery. We still don't have a lot of clarity on what achievable rents are today on those buildings. In industrial, it's the same thing. Montreal, Toronto, and Vancouver, we had explosive rent growth. That rent growth is retreating, but still at very healthy levels. So we continue to see accretive leasing, especially when leases expire. But the achievable rents that we're baking into our valuation models have come down from that peak. And then in residential, it's been an adjustment, but it hasn't been a massive reset or a complete revert. It's more of a cooling off of that exceptional rent growth that we've seen year over year. So in most cases, it's a slight recalibration to market rents or adding in some incentives. And then with retail, it's a very similar story, particularly in the grocery or necessity-based segment. We've seen high levels of occupancy, accretive leasing, and really, really, really strong investor demand. So that's really what's playing out in kind of all the major sectors.
And it's strange because retail, first of all, I mean, it was incredibly out of vogue 5 years ago, let alone 10 years ago. So everything does have a cycle. And here we are back with investors can't get enough retail. But it was also supposed to be impacted by tariffs and consumer confidence and all that. And yet we haven't seen that, right? Like, or at least on I don't know the details of how much money a grocery store is making, but at least on the leasing side and the investment side, like we haven't really seen that downswing in any way. If anything, like essential retail's a defensive asset now, right? I don't think retail maybe was considered that 5 or 10 years ago, but we're into this, like it's a safe haven asset, maybe more so than others. Is that fair?
Yeah, I think the pandemic shone the light on that. I think pre-pandemic, when capital was all office and industrial and multi-res, retail was kind of secondary. With the pandemic happening, it showed that resilience in those tenants and those cash flows, and that's very attractive, especially when there's levels of heightened uncertainty. Investors are looking at that asset class now, particularly the necessity-based sector, and that's really attractive because there's a lot of resilience in those cash flows.
In a deep pool of tenants. I think the retail story often, in my mind, focuses too much on Nordstrom closed, the Bay closed. We're running out of tenants. Okay, maybe at the million square foot level, we are running out of tenants. I think at the strip plaza, sandwich store, pharmacy, LCBO, it's fair to say the tenant demand almost exceeds supply there. Like
we
if
do
you have
tend
a
to
vacancy,
broad brush assets. And I think the pandemic, again, shone the light on this specific sector. But pre-pandemic, it was office, industrial. People were paying aggressive pricing. And now what we're seeing is a recalibration of achievable rents and bifurcation in almost every sector.
Yeah. Now, let me ask a little more off apartment and industrial. I mean, bulletproof for years, decades, right? But I am a big fundamentals believer. Population growth being the fundamental that drives it all, or you can say growth or the job market. But, I see a lot of what's happening in housing is just tied to, we had high population growth, we had really high population growth, and then suddenly we wake up in 2026 and population growth is zero. There's probably more to it than that, but like it does seem like apartment and industrial are much more exposed to just how's population growth doing, how's immigration doing, how's the labor market doing. That's a little reductive, but are the downswings we're seeing there? Like, I don't think it's even debatable that multifamily rents are down. I mean, you can read that on the cover of the newspaper. As you pointed out with other assets, you're still marking the market higher than when a tenant from 5 years ago leaves, you're still ahead. But is it just a matter of like the fundamentals and the sort of demographic demand that drives those sectors maybe more than the office market?
Yeah. So for multi-res, rents were just on this incremental clip until there was some changes to government policy, and that kind of cooled everything off. But I think from a long-term perspective, immigration will come back, and that will continue to fuel rent growth. Will the rent growth be as explosive as before? Hard to say, but I think we'll see a rebound in rents at some point. For industrial, the biggest thing has been the occupier uncertainty. For a big part of the last kind of 12 to 16 months, what we're seeing in sort of our leasing discussions is that most occupiers that are susceptible or prone to geopolitical events or tariffs, they're just sitting on their hands. So unless they're forced to make a decision, they're not. But I think long term, what we're seeing and hearing is that eventually this will work its way through and then occupier demand will come back. And I think people are pricing that into their underwriting.
Yeah, I think when the whole tariffs thing flared up, I thought industrial is the tip of the spear. It's going to be the most, like, if you look at all these tariffed industries, they're major users of industrial space. They aren't major users of office and retail space, automotive, agriculture, resources, metals. But it's just sort of, it hasn't like decimated that market. It can't. And there is a certain momentum to leasing where, yes, they want to wait, but at some point your lease expires and you can't wait anymore. You have to do something one way or the other. You have to relocate, you have to expand, you have to downsize. So I think one thing we're seeing is like the gap between investment and leasing is quite large right now because leasing has its own momentum of just lease turnover. Things need to happen, whereas investment, it's very sensitive to the conditions, investing at the right time, getting a good price, lending. And there's so many obstacles in that area right now, whereas leasing just sort of the wheel continues to spin because it has to. Is that fair?
Yeah, I think, one of the things that we're seeing play out in real time, and I always say this to our portfolio managers, is if you've been marking your assets correctly, what you should be seeing and what we're hearing from our leasing teams is rents are continuing to see some downward pressure, but that pressure is easing up. So I think we're getting close or nearing to a floor in industrial rents, particularly in Toronto and Vancouver. So just, to answer your question, I think we're near a floor, but we're expecting to see something as we play this out and we get over this geopolitical uncertainty, we get through all the tariff things, we'll start to see absorption come back. And what we are seeing is rents starting to kind of match where appraisal market rents are at. So it's just less of a decline now.
Okay. Well, and we've talked a lot about the demand side. There's the supply side too. Like development is way down for pick your asset, office, industrial, retail, condo. Although purpose-built rental, I was going to ask about this, is kind of the one area where like, do you have concerns in terms of like, that's an area where rents have softened and actually development is sped up in that area because it's so sensitive to government policy, CMHC making projects viable that honestly maybe weren't viable without that sort of longer amortization, lower rates environment that they're offering. So do you have any concern that housing, like we're getting a little ahead of ourselves in terms of the development side? Like there's still a bigger downswing, not on the demand side, but maybe on the supply side, too many apartments coming into the market, too much supply, and that's going to push things further? Or are we, you mentioned like rents kind of finding a floor in the other markets, which I agree with. Like a development pulls back and we start to find the equilibrium pretty quickly. Rentals is the one area where I'm not sure about that one, though.
We're starting to, we continue to make adjustments, but they're not significant. It's like an adjustment every quarter as a leasing activity comes in, but we are hearing that that's starting to kind of taper off. So I think for multi-res in particular, this is just a temporary kind of lull. Just need the rents to play out for that new sort of like development cycle or the absorption cycle to start happening again.
Yeah, agreed. Okay. We've talked about all the asset classes. Let's talk a little bit bigger picture about the market. So investment volume, 4 years ago was at crazy all-time high volumes. It's come down a lot. Maybe not as much as we think, but certainly investments happening less frequently. Trophy deals are happening less, but we are still seeing transactions happen, maybe a different buyer profile. Maybe they're a little smaller than we expected, but what's driving the liquidity? Like what's driving someone to invest right now? Just impatience. You can't wait forever in the market. The lending situation is more favorable. Valuations are more favorable. Like what's driving a transaction today versus 4 or 5 years ago?
Yeah. So from an institutional perspective, it's really about portfolio rebalancing, and it's happening in sort of two ways. It's either portfolio managers are either overweight in a certain sector and asset class and need to recalibrate, so they're disposing, or they're acquiring because they're honing in on a sector where they see conviction and they may be underweight. So a lot of the investment activity we're seeing of late is more of a portfolio rebalancing exercise as appraisals continue to evolve. So depending on how you're marking your appraisals, you may need to make those adjustments. And that's really what we're seeing in investment activity right now.
That's interesting. Yeah. The bigger, like the market, we saw this at the RealPAC presentation. There was a point in the market where all that mattered was allocation. The more industrial you had, the better your returns, and the less you had, the worse your returns. But that ends up skewing your portfolio years down the road, right? Suddenly you wake up today and you have maybe a little too much industrial and it's time to buy office at a discount. Like there is, I think that rotation there is interesting. The other thing I think we observed on the brokerage side is like the private investor has taken a larger and larger share of the market. Like compared to 10 years ago, it's just night and day in terms of like the presence of the REIT and the institution is greatly reduced, and that the private investor thinks about things a little bit differently, perhaps not the way you as an AACI certified appraiser thinks about things. Is that fair to say? Like their investment parameters, what they want, what their time frame is, how they consider something worthwhile is different than perhaps the institutional view.
If you don't have a portfolio weighting target, then you're not forced to make certain decisions. You may not be forced to let go of assets that you really like and are performing well. So there's one component of that. From the private perspective, they may not have those same requirements. So they're free to maybe be more free on what they purchase, what they acquire, what they dispose of. I'm in the fund space, so it's all portfolio weighting, portfolio performance, and a lot of the larger, chunkier transactions that happened in the back half of 2025 and into 2026 has largely been portfolio rebalancing. And we're seeing that because we've been a part of these transactions and being part of industrial transactions and surprisingly office transactions. If you can get office at the right price and the right return, it's attractive.
We actually were looking at the RCA investment volume, and it was how much volume is there, but how's it doing year over year? And probably not surprising, office was like up the most year over year. office has moved down a lot from the former largest asset class. It's nowhere near that anymore. But while, there was some pullback, like apartment investment was down and office investment was up, which, 4 years ago would have sounded insane to say that we'd ever be at that point, but the cycle does play out eventually. Okay, so when we put this all together, yields are stable, liquidity is okay, maybe not as good as it was. Income is maybe a little bit softer. Rents are down in some sectors. So I'm feeling slightly pessimistic from this discussion. So it seems like valuations still are maybe pointing downward for 2026. Like there's still some adjustment downward that needs to happen, or it's just totally case by case, depends on the asset, depends on the market, depends on the asset class.
I can't speak for the entire investor base, but what I can say is, depending on how robust your appraisal program is and how well you've been keeping up with the marks, particularly on the income side, that's going to dictate how negative or less negative you're going to be over the next, let's call it half year. That's my perspective. So it's really a large part of this is just how robust your appraisal program and have you taken the appropriate adjustments. So just going back to the MSCI results, I feel that the results are a bit muted, and there's reasons for that. We've been a part of a bunch of transactions. I have an appraisal program of 350 plus properties. So there's a lot of comparisons that I can make relative to the benchmark. And I'm just not seeing those adjustments coming through. So I think depending on how robust your appraisal program, you're either going to take way more of a write down or your write down is going to be less negative.
Fair enough. Now, I'll tee you up on one of your favorite topics, which is appraising in the market without transactions or with very limited comps. We've been talking about this for years. How do you anchor? For only so long can you wave your hands and say, well, there aren't any comps and there's no transactions, so we'll just keep the old value. How do you stay connected to reality? Do you look at markets outside of Canada? Do you look at past cycles? Do you just start to, you've referenced, it's just about the operating income and the leasing more specifically, in that absence of here's the signature new benchmark transaction that we all work off of, what's your method? Give us a little look at how do you kind of keep up with reality there?
Yeah, I've been somewhat critical of this. I argue that there have been meaningful signals in the market to recalibrate or adjust your appraisal values, and that's largely been in achievable rents. We've seen it through the statistics, and almost every single sector, rents for the most part have seen a lot of downward pressure, except recently in terms of trophy office, where we could argue that rents are maintained. But in terms of keeping your finger on the pulse or having conviction or confidence in your value, I break it down to just good governance. And I break it down into kind of three things: people, policy, and process. So in terms of people is, do you have an independent valuation team that is able to make the calls and adjustments independently? Are you leveraging the good people around you in terms of specialty lease or your internal specialty teams, like your leasing professionals, your research team, your investment team, to kind of get that real time data of things that are brewing in the background, but may not be coming through your database. So it's really a mosaic or a collective. And one of the fortunate things at BGO is because we're fully integrated, everybody buys into the valuation process. So I'm getting real time information beyond what's in our accounting system, beyond what's in third party stats. So it's really a collective. It's a lot of conversation to get expert opinion on rents, on where investor return expectations are or going, what the research team is thinking about in terms of, current and forward-looking trends, and putting that all together, and then ultimately using an external appraisal provider that is fit for the asset. So, it's really a difference between a generalist and an asset expert. So, using all of those things, that's what gives us, confidence and conviction in making value adjustments. And then in terms of our process, it's really about efficient information flow. If the information is not flowing it's going to drag your assumptions or not allow you to recalibrate your assumptions in as real time as you can. And that's what really creates the appraisal lag. And then in terms of policy, it's having a policy that enforces good appraisal governance. So how you're selecting appraisers, who's in running the process, and ultimately who's booking and approving values. Like it's those three things in a period where there's maybe less transactional information that's gonna, underpin your appraisal process and give you more confidence that your assets are fairly valued.
I like that answer. Okay, a couple, we're in the home stretch, couple more. Why does this matter? And to the degree that we've talked a lot about, okay, there's a gap, perhaps things are not realistic or they're not keeping up with the market. Why does this matter? I mean, I think plenty of people are happy that there's a gap and that it's not keeping up with the market and that old valuations are being maintained. But at the same time, we're talking about repricing isn't happening. It's stalling the investment market on a more general level. Maybe it's making Canada less attractive if you're looking at the whole Germany versus Hong Kong versus Amsterdam, like why we're not keeping up our end of it. Like, why does it matter as a landlord, as a fund manager, from the investor side, lender side, that we have any gap at all?
Yeah, I would say the importance here is if capital allocators from an open fund perspective have uncertainty or they're questioning the unit price, that's either going to stall or completely stop capital moving into those funds. And if that happens, there's no allocation, there's no transactions. It really halts the market. So if your values are off and there's uncertainty or maybe not trust in your unit value, capital allocators are not going to allocate capital to your fund.
And I think something we hear at most of these real estate investment conferences is fund flows are not so good. They're not what we want them to be. I think everyone would admit that. I don't mean to put you on the spot as a fund manager, but I think anybody in the market would say that like fund flows are not where we want them to be. Yeah. And this maybe is like a small, I'm not going to pin it all on appraisal lag, but that's certainly
it's a big part.
I
mean, it certainly is a big part. But I would just say ultimately it comes down to trust. If the capital allocators believe and have conviction in unit price and they're ready to deploy capital, they will do it. If they don't believe that the appraisal is fairly valued or the properties are fairly valued, your NAV is off, that's either, like I say, delay the capital deployment or completely stop it.
And let's put this in the context of like investment generally. Like you don't have to invest in real estate. You can invest in bonds or cash or Bitcoin or gold or large cap stocks or whatever. And those are responding by the minute, right? So like we're putting ourselves at a bit of a risk. Real estate's slow moving. It's a little more opaque, which can be very much to our advantage and can outperform. But I think, do you also get some of that pushback of like, well, if I'm deciding on real estate versus European stocks versus Canadian bonds, like this is not keeping up. There's no choice in that universe whether you're keeping up with the market because it adjusts every 15 minutes or something versus real estate. The lag is maybe a problem in terms of getting people into what they would consider an alternative asset or a non-standard investment.
Yeah, relative value is certainly a thing, especially for capital allocators. But what I would say is that I don't believe that the appraisal needs to be precise or exact. I don't think capital allocators are, looking at it from like the closest dollar. They just want to know that it's fair and it can be explained. And I we look at the index results, we see Canada like all the way at the bottom. So that, it's really been a slow grind. I think Canada's just still working its way through. It just needs to speed up a bit. And hopefully with liquidity coming back to the market, leasing transactions, leasing momentum continue to play out. Like I said before, it's going to be some people are going to take bigger write-downs and other people are going to take lesser write-downs. But it's all moving towards, I believe, positive appreciation at some point.
It has to. Okay, so we'll give you the soapbox for kind of a closing question. You've convinced me on the importance of valuation, but like what needs to change? What needs to improve? Like if we're lagging a little bit here and we're not keeping pace, like is it a data issue? Is it a methodology issue? Is it a trust issue? Is it a technology issue? Like what needs to where do you see the improvement needed in appraisal in the next 5 years?
Yeah, so there's definitely been a monumental shift towards, in Canada, higher frequency valuation. And the only way that that works properly is if there's efficient information flow and good two-way communication between your internal people, the people that are running your investment group or your evaluation group, and your external appraisers. If there is a break in that chain of information, the appraisal suffers. So I think it's really all things. It's data, it's the appraisal community skilling up in terms of higher frequency valuation. That seems to be more mature in the US than it is in Canada. It's something that's certainly growing. And it's really that, landlords or funds facilitating that information flow so that it's efficient and things are happening in real time.
Okay. Now the bonus question, which we talked about beforehand, I get asked about AI and the implications of AI in real estate all the time. It could change investment, property management, leasing, marketing. Like there's a lot of potential. And at the same time, I don't know that we've seen the transformative use case just yet. However, appraisal, I think, is one that might be in the crosshairs. It's a sort of repeatable process. It's dependent on data. So do you see a world where AI-enhanced, AI-enabled appraisal is happening in the next, 3 to 5 years? Or is there just, I've heard the other side of the argument, which is appraisal is about trust, accountability, a lender being able to go to an appraiser and say, you put this value on this asset, I need a validation of that. Where do you fall on this? You're optimistic about it. You're allowed to say, I'm a skeptic. You're allowed to say, you don't think this is really going to have a significant effect. It's not the way the industry works. So where do you see AI falling on the appraisal side?
Yeah. So listen, I'm on the internal side. I think for external appraisers, there's a lot of benefits that they can leverage by using AI, and we're seeing it. There's a bunch of appraisers at the forefront of implementing AI in terms of like gathering intelligence, creating a new report, collecting comps, and ultimately allowing them to spend more time on the analysis rather than the creation of the report or the updating of the model. Like that's one part of it. From my perspective, from a governance perspective, we can really harness the power of AI through governance. So that's data verification, accuracy, reporting accuracy, identifying anomalies, making sure things make sense, our reports are compliant with industry standards. Like all of those things, I think, are real and can be implemented faster, say, than automated valuation models or an AI tool completely providing a value. So, that might take a little more time, but I think in terms of practical AI uses, that's where I see it happening. And that's where we're trying to implement it.
That makes sense. I think AI on the data collection side could be incredibly powerful. I think the analysis and underwriting, I'm not as sure, but perhaps someone said to me, we always underestimate in the long term how big the impact. We overestimated the short term, and it's going to change everything and eliminate every job. That doesn't happen. But then in the long term, the transformation catches up with us.
I certainly think there's practical use cases where it can help, but there needs to be judgment, and real estate is so unique and nuanced that I'm not saying it can't happen. I'm just saying it's not here right now.
I agree. To be continued. Okay. Thank you very much for joining us on Colliers Talks. Our guest, Amedeo from BGO, gave us some wonderful insight on the appraisal profession, fund management, the perspective of an institutional landlord. So thank you very much. I hope this was valuable for all our listeners and watchers, and we look forward to talking to you next time.
Thanks for having me.
Thanks for listening to Colliers Talks podcast. To learn more about Colliers Canada, our experts, and our solutions, visit collierscanada.com or find us on LinkedIn, Twitter, and Facebook.